In today's video, I'm going to be comparing two of the most popular ETFs head-to-head. SCHD, the Schwab US Dividend Equity ETF, and VOO, the Vanguard S&P 500 ETF. These are both solid ETFs in their own right, but let's imagine we live in a world where we could only pick one. I'll break down everything you should look at when picking a fund, including capital appreciation, dividend yield, top holdings, fund strategy, and more. Time is money, so let's get moving. Let's start with the methodology that each fund uses to pick what holdings make up the ETF. Generally speaking, VOO tracks the S&P 500 index. The S&P 500 is an equity index made up of the 500 largest companies traded on either the New York Stock Exchange, NASDAQ, or CBOE. To be eligible for S&P 500 index inclusion, a company should be a U.S. company, have a market cap of at least $11.8 billion US dollars, be highly liquid, have a public float of at least 10% of its shares outstanding, and its most recent quarter's earnings and the sum of its trailing 4 consecutive quarters earnings must be positive. Notice that with this methodology, there is no mention of dividends. VOO does pay dividends to its shareholders, but it's not a factor for inclusion in the fund. SCHD also tracks an index, but in this case, the fund's goal is to track as closely as possible the total return of the Dow Jones US Dividend 100 Index. To be eligible for the SCHD fund, a company must have a history of at least 10 consecutive years of dividend payments, have a $500 million market cap, and a daily trading volume of at least $2 million. After those criteria are met, the fund managers look at the best combination of cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate, and select the 100 highest yielding stocks among the qualifying group. So to sum up the methodology, VOO tracks the S&P 500 and SCHD focuses on dividend yield, with both really making sure that they're only including quality companies. One important item of note is that SCHD does not include REITs at all in their fund, and the S&P 500 currently has around 30 REITs in its index. An expense ratio is relatively small with both funds, VOO coming in at 0.03% and SCHD at 0.06%, so that's really not a factor to be considered in the analysis. Before we jump into the dividends, I want to announce the launch of the Cashflow Nation Discord server, a community to talk and discuss all things related to dividend investing, and I will be there daily to engage with everyone. You can see the link here on the screen, and it's also below in the description. Right now, we're only accepting the first 20 people to sign up, and any of those first 20 that are active and help with input before our full go-live date will be assigned the limited role of OG, which will never be available again. I look forward to seeing you there. Now, moving on to dividends. VOO has a dividend yield of 1.36% as of the making of this video, earning $13,600 per year in dividends for every $1 million of VOO in your portfolio. And while this may seem low, it's actually not too bad for a fund that doesn't really put any focus at all on dividends. SCHD comes in at a dividend yield of 2.91%, meaning that the same $1 million invested would earn $29,100 in dividends each and every year. This is more than double that of VOO, and it's kind of expected since this ETF focuses on dividends first. If you're only focused on income, SCHD is clearly the winner, but that's not always the only factor in deciding what investment to make. Maybe you're focused not only on dividends, but also on total return. So in that case, we still need to factor in capital appreciation. VOO and the S&P 500 are well known as considerably safe investments, or at least as safe as they come for an ETF with such a high upside. And generally speaking, dividend-paying companies, which SCHD focuses on, are more mature and spend less money on research and development and growth, allowing them to pay investors instead in the form of dividends. But many times this leads to slower growth and capital appreciation. Take Amazon, for example, the third largest holding in VOO. They're growing extremely fast, investing all of their cash into research and development, new tech improvements, expanding their logistics network to provide customers with faster and more consistent deliveries, and so on. They feel that their money's better spent here than paying dividends to investors, and I tend to agree. But if we look at a company like Pepsi or Coca-Cola, the second and fifth largest holdings in SCHD, they're already in every market in the entire world. Their products are established and well known. There isn't a ton of room for innovation or a need for logistical or technology improvements. They of course need money for new products or acquisitions, but in general, their bread and butter products are complete and flourishing. They use a percentage of their profits to reward investors directly through the payment of a dividend. And the returns for those companies over the last 5 years, for example, reflect those differences in growth. Amazon has returned 261% over that period, compared with around 50% for Coke or Pepsi. So over the last 10 years, SCHD has grown around 100 183% and VOO over 220%. If you had invested $10,000 in SCHD 10 years ago, it would be worth around $30,031, and the same investment in VOO would be worth around $36,004, not counting dividends. And if we look at total returns, which includes both capital appreciation and dividends earned, VOO still beats out SCHD, although by a very small margin, 286 to 282% over the last 10 years. A quick look at the holdings of each fund shows us why we see the differences in growth and yield. VOO's top 10 holdings are highly concentrated in the tech sector, making up 1/4 of the portfolio with names like Tesla, Amazon, Microsoft, Google, and Meta. This, of course, accounts for its significant growth advantage over the last several years, and they are well diversified, holding 510 individual stocks. SCHD's top 10 holdings are more stable and conservative, with well-known companies like Coca-Cola, Verizon, Pepsi, IBM, and Broadcom in the mix. Financials and industrials make up a combined 39% of the fund. They are diversified, but not to the same degree as VOO, holding only 105 individual stocks right now. So there is a little more of a concentration risk associated with SCHD. Everything we've discussed so far talks about capital appreciation or dividends, but we really didn't talk about what happens when you choose to reinvest your earned dividends. This makes a huge difference when you're able to take those dividends paid and buy more shares of the ETF or stocks you're holding. We're going to look at a few scenarios and make some assumptions about the future performance of the market given the recent performance this year and the outlook for the short-term future. We'll start with the following facts. The S&P 500 has an average capital appreciation of 10.5% over its lifetime, which is less than the recent performance, but again, we're playing things to the conservative side. And SCHD has returned an average of 82% of the S&P 500 over the last 10 years, giving us a comparative yield of 8.66%. VOO has a 5-year dividend growth rate of 5.61%, and SCHD sports a 12.32% dividend growth rate, meaning that each year you hold these investments, the dividend increases on average by that percentage. We have no idea, of course, how the market's going to perform in any given year, so I'm going to play it very conservatively since the current market outlook is generally considered dim compared to the last several years. I'm going to use a market discount factor of 50% for both return and the already risk-adjusted CAGR. You can see I've forward projected the capital appreciation and dividends based on those numbers monthly for the next 50 years in the second tab. Let's assume we start with an initial investment of $5,000 and monthly contributions of $500. And keep in mind here, we're assuming that we're reinvesting dividends up until the point that we decide to start living off our dividend payments. After 10 years, we have $93,000 with VOO, earning over $1,200 per year in dividends, and just under $100,000 with SCHD, earning $3,700 in dividends. We can already see the difference made by reinvesting dividends. If we have a goal of earning, let's say, $1,000 per week on average in dividends, we never really reach it with VOO. And with SCHD, we get there in 36 years or at age 56 if we started at 20 years old. If we're able to increase our contributions to $1,000 per month, the picture changes drastically. We reach our goal with SCHD at 49 years old or in 29 years from the start. By age 50, we're earning over $61,000 a year in dividends, and our $1.4 million portfolio, it's about $400,000 higher than VOO, a 40% advantage. From my standpoint as a dividend investor, SCHD is a clear winner, and even in the periods that VOO has outperformed SCHD, it isn't enough to sway me from my long-term goal of living off dividends. Both are solid funds with different performance levels in different areas. I wouldn't say anyone's wrong in either choice, but again, for me, SCHD is more aligned with my goals and investing strategy. Thanks for hanging out with me and checking out these two amazing ETFs. If today's video helped you out in any way, pop that like button and subscribe to join the Cashflow Nation. I'd also love it if you dropped a comment below and let me know what you think and if you own one or both of these funds. Thanks and see you next time.